Yo, what up, guys? It's your boy Yield Sage. Um, Man, these markets are not looking good, right? I did not expect things to dip like just so hard so quickly because right now ETH is basically giving back all of its gains that it made in July, which is insane to see. Like I knew the RSI was overheated, overbought, but did not expect to see ETH at 3,300 going into Sunday. Um, and we all know Sundays are going to have less volume, so I don't know what to expect. I mean, we'll see if it dips below 3K. If it does, I'm probably gonna pick up some more ETH. But I mean, alts across the board are like mostly bleeding, right? If you're on crypto Twitter too, like low energy, I feel like most people are either like out of the market or they are proceeding to exit the market with no sight of a rate cut, no sight of alt season. Things feel kind of gloomy, right? But when you take a step back and you zoom out, this is really right. Usually when things get interesting, because this is like the part of the movie where you really want to start paying attention, right? So as things are bleeding, you want to be thinking about new opportunities. And so today in this video, I want to talk about a few things. What I want to talk about is why DeFi is still one of the best vehicles to make passive income or wealth in the world, right? That's across the board, not just traditional finance, but also on chain as well, right? DeFi, I think, is the way to do that. Second, I want to talk about why institutions are still putting money in DeFi, even though it seems like retail is not part of the journey. I want to talk a little bit about that. I also want to talk about how I'm personally navigating this cycle to not be overexposed, but also to not be underexposed. And then lastly, I want to talk about why you need to be treating DeFi as a system and not just a one-off play. So if that type of content interests you, stick around. Also, make sure you like, subscribe. There is a link to our newsletter, free newsletter, in the description. And let's get into it. All right. So if you've subscribed to our newsletter, if you've been to Yield Sage on X, you'll see me talk a lot about DeFi, right? But I think it's always good to have a refresher in terms of what DeFi actually allows you to do. So when you think about DeFi, there's really three main components in regards to how it lets you maximize some of your returns, right? So you can lend something like ETH or stablecoin and earn interest. There's no bank needed to do that. You can then borrow against those assets without ever asking for permission or KYC. So using those assets as collateral. So if you bought ETH or say BTC in the past, or you have a regular W-2 income paying job, you can bring those assets on chain and without ever spending down those assets, you can leverage them by borrowing against those assets to put into different yield bearing assets, which is amazing. Which leads me to my third point of why I think DeFi is amazing, right? You can provide liquidity for trading pairs and earn a share of those fees. So when you're looking at, different exchanges, you might see a pair. It could be ETH to USDC, USDT, or any exotic pair, which maybe is a token with another token, like say Mamo, which is an AI agent on base chain with something like Virtuals, which is an ecosystem token on base chain, right? You can effectively provide liquidity as people are trading back and forth through those pairs, generating fees. That is, of course, high risk, but it comes with high reward as well. And so when you think about DeFi in its ability to leverage and unlock different forms of income, these are the things that used to be limited just to institutions or investors with a ton of money. And now any regular person with just a wallet and some capital can actually utilize some of these different ways of earning income that just were not given to them before. right? And that's a core unlock because it puts more financial control directly in your hands, and it wasn't there before. So that's a big part of it, right? And DeFi activity is still super strong. It's not just about buying tokens on spot, right? There is a ton of wallet growth going on, a ton of volume, a ton of lending demand. People are still getting involved, mostly I think at a institutional level because there's a ton of demand now around, say, like assets like BTC or assets like ETH. And retail sentiment still feels low, right? And that's why I've taken, you know, I've taken on this mission of bringing more people into DeFi because when I discovered DeFi, I said there's no way something like this exists that a regular person could get into. And so for me, it's an amazing opportunity. Um, but retail is still quiet. Retail meaning the average person, right? But institutions, they're still moving, and I'll prove that. Right. So if you look at this recent article, spot Ether ETFs clock 5.4 billion monthly inflow record, 20-day streak. Um, this article is on Cointelegraph, and you can see that institutions are still pumping a ton of money into these ETFs, ETH ETFs to be more specific. And if you've been following anything on the news, a guy by the name of Tom Lee, he has pretty much launched a new fund, a crypto strategic reserve fund, all about ETH. And what they're doing is they're accumulating ETH, similar to how Michael Saylor has accumulated Bitcoin. And the idea is to lock it up, potentially stake it. Once the staking mechanisms are approved by the SEC, which they probably will be, and when you lock it up, the price goes up. And so that is a tremendous, tremendous boom for something like, say, ETH or just altcoins and crypto in general. And so if you've bet against Tom Lee in the past, you've been royally wrecked because he called BTC early days saying it would go past 50K, and look at it now, right? So it's not just about hype. It's about quiet, steady accumulation, right? All while people are asleep, not paying attention to what they should be paying attention to. Because if you zoom out and you go back a couple years ago, DeFi yields were mostly from token emissions. Some of that still is around today, but it's, I would say, fundamentally changed, right? Because now most of the better protocols they pay yield from actual demand, from people actually borrowing stable coins, actually doing swaps on chain. For example, if I lend some of my funds on, say, a protocol like Moonwell, for example, you can lock your money in a regular market fund, you can lock it in the vaults. But as you can see, I can get paid 5.2% on my USDC. I can also get a 1.3% yield on my ETH. If I go to the vaults, I get a 3.6% return on my ETH, which is a breakdown of the base APY. There's also well rewards in the form of emissions. So you get well emissions and then morpho rewards, which equals that total. With USDC, I can get 10%, which is a base APY of 6.32, well rewards, morpho, and then OP rewards, which is part of the optimism stack, that token. Where else can you get 10.4% from a stable coin, USDC backed and pegged by the US dollar? That's unheard of in traditional finance unless you're taking on additional risk. This is as risk free as you can get. Of course, there is protocol risk, there is contract risk, sure, but DeFi is really one of those fundamental finance structures I think that will be around for years to come. I don't see this thing going anywhere. The adoption from institutions says to me that they are trying to earn some of this yield on chain. So these yields eventually will go down. But the time that we have these yields, I'm trying to take as much advantage as I can. So here's what I'm doing with my capital as these markets are turning to the downside, right? As things look gloom and doom and pretty bleak, what I'm doing with my capital is one, I am lending ETH for base yield, right? So on places like Moonwell, on places like Morpho, you can come here and lend out some of your assets as well. Use those assets as collateral and then use that collateral or use those funds that you borrowed. So say as if you go and you lend out your ETH and then you borrow USDC against that ETH, you will of course pay an interest fee on what you do borrow. But the idea is if you're taking that USDC and you're putting that into a higher yield opportunity, you should be able to not only pay off the interest from the loan, but generate additional yield on top of that. And so you want to pick blue chip pools if you are a bit more risk averse. But if you are more risk on, you can pick exotic pairs as well, which can provide a crazy amount of APY. If you go to a place like Beefy, you'll see what I'm talking about. So if we go to Beefy and we go ahead and just filter some of these chains, if this is your first time here, I'm going to do a breakdown on Beefy in some of my upcoming videos. But you can come here and you can see some of the APYs for some of these pairs. Something like, say, Wrap, ETH, and DGen, or Mamo and USDC, paying upwards of 200% APY. Now, how can they afford to do that? That is from a mixture of the swap fees and volume that is coming through these pairs. And they're riskier pairs because they're smaller in cap, right? So Mamo, I think right now is sitting at about 30 million in market cap. And so any amount that goes into Mamo can fluctuate the price in a very aggressive way. And that's to the upside, but also people are selling us also to the downside. So if you're farming and doing liquidity for pairs like say Wrap, Ether, DGen, or Mamo, USDC, et cetera, just know that there is additional risk that you'll take not only from the price fluctuations, but also just from the overall risk of the pool itself, right? So I'm not here to chase breakouts per se. That's why I like to provide a ton of liquidity in different positions and pairs and tokens that I wouldn't mind owning. I wouldn't mind owning anyway. But I'm essentially just building my base to make sure that the system that I'm building for my DeFi business is where it needs to be. And so here's what I think most people miss really about DeFi, right? The real value in DeFi shows up when you treat it as a system. Like I mentioned before, that's doing things like, say, lending your ETH where it earns yield, not just in cold storage per se, not just in your hot wallet, but you're giving it an additional way to generate money for you, right? Borrowing some of those stables if you want to take on some additional risk and you're long the assets that you already own. So if you are bullish on ETH and you want to effectively take a leverage long against that position, then you can borrow against that, buy more ETH, put that back into the supply that you already have, or you can take those borrowed assets like USDC and put that into something like a ETH USDC pool, paying you upwards of 20+%, taking those fees that you generate, compounding that back into the position, using those funds to pay for your lifestyle, or using those funds to purchase additional ETH to then put back into the supply position that you have on one of those platforms like Morpho or Moonwell, right? So you can do whatever you want with that money, right? It's a loop. And if you stay consistent, it builds over time even in some of these sideways markets. It's not necessarily passive, but it's structured. And that's what makes it really, really powerful. So, with all that being said, I do want to close out with just a few lasting thoughts, right? ETH might keep dipping, and I anticipate that it will, or it could come up for air in these next months. No one knows. If you look at like Ben Cohen, if you follow him at all, he has some predictions on what ETH could potentially do in September. If it pushes higher in September to 4K, then we'll see a breakout in the later part of the year, with some people calling for 5K, 6K ETH. Possible, yes. I do not know if that will happen. But as ETH continues to dip, I will continue to add to my position because institutions are buying. And I'm trying to chase smart money, right? I'm not trying to necessarily guess. I'm a speculator, sure. But sometimes it's easier just to follow the herd, especially if you can front run them in ways that helps your backs. Stay close, right? To all of this information, stay close to some of the charts. Um, what I want to cover next time is going to be some deeper dives into why I feel that DeFi can really stand up against some of these other asset classes when it comes to, say, traditional stock investing, traditional real estate investing. I do own real estate as well, but the yields I'm generating through DeFi trumps all of those yields I get in real estate. So if you haven't already, subscribe, like. We have a link to the newsletter down in our description. Drop a comment. What do you see this market doing in the next couple months going into the end of the year? What do you want to see us talk about and highlight in some of our episodes? But that being said, appreciate you guys. Thanks for listening and talk to you soon.